my next guest says that it's really important to diversify portfolios and to think about downside protection where possible. I mean, we're taught that time and time again when we see markets react to whether it be geopolitical risk or political risk. We know that downside protection is important. So Justine Marquet from Allianz Retire Plus joins me now to explain it a little bit further. So it's downside protection. And is that because you want to be able to sleep at night as well?
Yes. So we want the opportunity to participate in growth and have an investment in preparation for and during retirement that still will grow and sustain the portfolio. But with that built-in downside protection for sleep at night factor, and also to reduce the volatility in the portfolio so that you're de-risking the portfolio, particularly in these very volatile and uncertain times. Having that level of downside protection is increasingly important, and we're seeing a lot of interest in being able to provide that level of protection built in.
Yeah, and by virtue of employing strategies that provide downside protection, does that also bring about diversification?
Yes. So we definitely think that we need to change up traditional strategies. So certainly diversification has always been important, but this is an improvement to that diversification. It's another layer of diversification with an investment option that includes, as I said, a growth investment with downside protection, and then lifetime guaranteed income when the investor's ready to move into retirement or turn on their income and start drawing down. That gives them that reliable, stable income. So it addresses things like volatility in income levels with changing portfolio values, and also, of course, the prospect of decreasing interest rates. With the prospect of interest rate cuts, having the ability to build in some reliable income that will never decrease really provides that diversification to the portfolio, while other income sources that retirees are generally relying on, fixed income sources like term deposits and things like that, this is just another income source that isn't aligned to the fluctuation of those other asset allocations.
So just to be clear, so guaranteed income for life. Like, what does that mean? Does that mean at the same percentage, the same level?
That's a really
in perpetuity.
Yeah, really great question. Certainly in perpetuity for someone's lifetime, and potentially reverting to their spouse for their spouse's lifetime if the first income recipient passes away. So that can be built in. But the guarantee, understanding that is really important, because we have different investment linked type lifetime income streams around, don't we? And this one can be a fixed income that is the same income for the rest of someone's life, no matter what happens. If they run out of money, all of their other money, the underlying investment disappears, they still keep receiving a fixed income. Or they can opt to receive a rising income that rises in line with our equity index option, but is still guaranteed never to decrease. So the starting rate would be lower, but the investor can participate in upside. So that helps keep in line with the increasing cost of living and those kinds of things. So that optionality is there, and we see people sometimes taking two investments, and they might start one on a fixed level of income at a higher level for their higher spending at the start of retirement, but with another layer of income locked away to start as a rising income. So we'll start lower, but will increase over time to keep up with those costs of living.
So I don't want to get too far into the product, but what this means then is that people are able to move from one strategy to another within their their retirement phase, or is it different things that you can do in different phases of life?
Different things that you can do in different phases of life. So while you're investing in most market-linked lifetime income streams, you can switch up the investments along the way while you're still growing the investment. And then once the income's turned on, a choice must be made. So that's why we see people taking multiple investments, because they can then make different choices with different policies, different investments. So there's lots of optionality around for investors to select the type of income they want, fixed or rising, to select the underlying investment options. And importantly, with these new innovative lifetime income products, there's the opportunity to still retain access to the underlying investment value. So you're not giving up your capital as a swap out for the annuity, you're able to access that investment value. So if something changes significantly in your life, or there's an unexpected expense spike, one-off cost, people are able to access that investment. And of course, it's only one part. It's a diversification play, so it's only one part of the whole portfolio. They've always got those other investments and some cash available as well.